Cim's outlook for 2015 is that we think that there's going to be a divergence in economic output within advanced economies as well as emerging markets. For advanced economies, we are forecasting about 2.3% GDP growth for 2015, but for emerging markets, about 4.3%. Now, if you look at advanced economies, they're not doing so well simply because there's really an output gap, which means that there's going to be a difference between what they're actually going to be doing as well as what potentially they can be doing, simply because they've got budget issues and they cannot invest in the capital infrastructure, so on and so forth. So that's why the advanced economies are probably not going to be doing so well compared to emerging markets. Now, talking about the risks, we have different areas, we have different risk factors. For example, in the US, it's really about the timing of the interest rate increases. That's going to change dramatically all the asset classes, prices of asset classes globally, actually. That also might also put a brake on the growth trajectory of the US economy. So that's something which we need to take a look at. For China, it's really a difference between a soft landing or hard landing. Also, they've got overcapacity as well. They have a lot of unsold real estate properties. That's the risk for China. And of course, if you look at Japan, they've got deflationary risk as well. They've been having that for the last 20 years. That's probably going to continue as well. Globally speaking, we're going to have a lot more volatility in FX flows as well as equity prices simply because of all the different things which are happening. Well, CIMB's outlook for the United States is that they're probably going to do well, but not as well as they can be. It really depends on the timing of the bond tapering program. So as you can see, the US Fed, Ms. Yellen, under her leadership, they are very careful about increasing interest rates. So they've already guided that interest rates are not going to increase in the first half. Right? And if you look at the FOMC meeting minutes that came out last week, really they are actually quite dovish about increasing interest rates. They really want to make sure that growth in the US economy is kind of entrenched before they actually do anything drastic. So I would say that if, let's say, interest rate increases probably going to happen at the end of this year or probably early next year, but not anytime soon, simply because the US economy is not strong enough to do that. So the mixed data in the US economy has been going on since the beginning of this year. So what you can see is that the labor market is still relatively strong, but everything else, things like income growth, housing starts, spending, so and so, industrial production, GDP growth, first quarter was terrible. So I think you're right to say that because of the weak data, the US Fed is probably going to hold off interest rate increases, probably maybe to fourth quarter this year. That's CIMB's view, or even first half 2016. So we don't think that that's going to be imminent at all. Well, the EU economic outlook is not terribly positive. So the EU, since the great financial crisis, has been kind of flirting with recession, technical recession, and of course, we have got this problem or the challenge with Greece. So since February, since they've asked for extension in the bailout terms, they haven't really come up with a precise plan on how they actually want to use the new money and how they actually want to get back on the reform program. Okay, so that's still in discussion, and that actually added a lot of volatility to both equity markets as well as bond markets. So there's a lot of speculation as well as concern over whether or not Greece might actually accidentally move out of the EU simply because of its deteriorating banking sector. So that's still in the works, so not really sure. If you're talking about the European QE program, they are probably 5 years too late. They should have done it when the US did it. But I think what they've done is that they had a lot of issues politically about actually expanding money supply. So once that's done and you've got a new EU ECB chief come in, right? He's basically embarked on a quantitative easing program which is very similar to the Americans, which is kind of like unsterilized quantitative easing. So what they're trying to do is actually to expand money supply. As you can see in the EU, right, the deflationary pressures are still very strong. So inflation is not there, and basically they're giving it the ECB a lot of flexibility to actually expand money supply. Hopefully you want to reduce cost of funding. That will encourage people to buy big ticket items like cars, like houses, so on and so forth, and basically to increase consumption. So when consumption is higher, people get better jobs, income goes up, they'll spend even more. So that's kind of a virtuous cycle they're trying to kick in. So that is still very much in the beginning. So we have not really seen really good economic data that supports that yet, but we're actually hopeful that that's probably going to be beneficial to the EU, because based on the behavior of what happened in the US, so we think that's going to be a positive development. When the new Prime Minister of Japan came on board, he had three arrows, right? Abenomics, right? So firstly was monetary policy, then he had fiscal policy, sorry. The last one was really about labor market reforms. That really hasn't taken root because of cultural reasons as well as political reasons. And also because of, and part of the third arrow was because of trade pacts. So you've got the Trans-Pacific Partnership, which got a huge boost in the Senate, U.S. Senate yesterday. That's when they actually voted to grant the president a fast-track authority. But the thing is this, right? There are serious structural problems in Japan. So 1 quarter of higher than expectation GDP growth is probably not going to be a trend. What they really need to do is follow through on the restructuring program and make sure that the economy is on a sustainable path to improvement. So 1 quarter, good, but we want to see more positive data coming out of Japan. I think the baseline scenario is that China is going to succeed in its soft landing. There's a very, very remote possibility that China will have a hard landing, but that's very small probability of happening. Now, our view is that China's GDP, the last quarter was about 7%. Going forward, third quarter, fourth quarter, it's probably going to dip below 7%. Full year might actually come in about 6.9, 6.8. I don't think that's a concern simply because lower GDP growth is actually something which the government wants. Right? The economy itself can actually do much more. It's just that the government is telling the state-owned enterprises as well as the private enterprises that, hey, we want you to grow, but we want quality growth. We don't want you to grow at any price. So they can actually do 8%, 9%, 10%. That's actually fine for them. But they want to have quality growth. So they are happy to trade off lower growth but better quality growth to put China on a sustainable path to development. Well, I mean, it's been happening for some time, but actually, essentially what they're trying to do is to restructure the Chinese economy so that it won't be so much export-oriented, but like the US, they've got a huge consumption. The economy will be driven a little bit more by consumption, internal consumption, rather than export-driven. That will be actually very good for China. You put them on a more sustainable economic path. I think the Chinese government may give or really embark on more stimulus packages, but that really depends on whether or not the economy goes into free fall, right? So the Chinese government is targeting about 7% GDP growth, but if actually the economy actually does worse, maybe 6.5% or low closer to 6%, and that happens in the Q3 or Q4 too soon, I think the Chinese government will probably contemplate having another round of stimulus plans, stimulus package. Well, our base scenario is that the GDP growth for Thai economy for 2015 is probably going to come in about 3.6%. For 2016, it's going to be 4%, and 2017 is going to be about 3.8%. We think that expansion in the Thai economy is going to be driven by a couple of factors. One will be an improvement in the export market, right? So you've got improvements in Europe as well as US as well as China. So Thailand is probably going to benefit from that. Second thing is, of course, lower fuel costs. So energy prices are going to be down. So that means that people who have traditionally had to spend a fair bit of amount on energy, on petrol and all that, they can actually use that to spend on stuff, things like clothing, shoes, bags, iPhones. That actually is going to kickstart the economy. And of course, the last one is the Thai government has announced that it's going to spend $100 billion on infrastructure projects, right? So public investment is definitely very important for Thailand, not simply just because of the amount of money, but because it needs to upgrade all its infrastructure. Now remember, Thailand is part of the AEC, the ASEAN Economic Community, and in order to be able to leverage as well as capture a lot of the benefits coming from that, Thailand needs to be ready in terms of infrastructure so that it will be able to quickly move goods and services from its production plants to its export markets. Right? So that's actually a plus as well. So we expect that the Thai economy is probably going to do very well for the next 3 years.
Okay, and what are the policy recommendations for Thailand prospects?
Well, a couple of things. So firstly is a lot of the public investments are probably going to be driven by the state-owned enterprises. If you look at some of the state-owned enterprises, they are unprofitable, similar to China as well, simply because they are providing a public good. So for example, the National Railway Company, right? According to the Asian Development Bank, since between the years 1993 as well as the year 2009, the number of passengers actually dropped by 41%. But the number of trains is about the same. So 70% of the passengers which travel on the rail actually pay a very low fare, which means that this company provides a public good, people like it, people travel, but it doesn't make any money, right? So that kind of losses is actually going to be reflected in the books of the government, so which means that it's, taxpayers are going to have to pay for it. So that's great, but the thing is that after a while, you need to kind of stop that. So you need to make state enterprises held more responsible for their numbers, make them more efficient. So although they need to provide public good, they can't be losing money all the time. So they need to kind of staunch that. So that's one. Two is, of course, in anticipation of the AEC, right? We also expect that Thai government should actually also invest in education. Okay, So you want to have transferable skill sets, good standard of English, so on and so forth. Because you've got so many different economies, right? But English is probably going to be the language of finance, language of business, sorry, commerce, right? So English is going to be very important. So probably there needs to be a lot more investment in language skills, communication skills.